Now, I would like to restrict my coverage of the syllabus till here. Now we can take up like certain questions which certain small queries or questions you might be having in the question in your mind, and most of the students have these queries in their mind at the time of examination, and Miss Akansha would be taking up all these questions with us.
So though you have clarified this earlier, but still we keep on getting this query regarding the applicable assessment year and Finance Act.
Okay.
So for December 2014 examination, I would like to clarify that assessment year 2014-15 is applicable and Finance Act 2013 is applicable for December 2014 examination. That is for both old syllabus and new syllabus.
Right.
Now regarding the pattern of examination also we are getting queries. So for this also I want to clarify that pattern of paper will be elaborative for tax laws old syllabus, and for the new syllabus, that is tax laws and practice, the pattern of paper will be OMR based. Okay, and the weightage of marks will be tax laws old syllabus, that is divided into three parts. Part A, direct tax portion, which will be of 60 marks, and part B and C, service tax and VAT, for 20 marks each. And for tax laws and practice new syllabus, the syllabus will be divided into two parts. Part A, direct tax, that will be of 70 marks, and part B, service tax and VAT, that will be of 30 marks. Okay. Now we are getting a lot of queries, and first query I would like to tell, explain the Provident Fund topics in detail under the head salary.
Right. Okay, let us see, friends, what exactly the Provident Funds are. Provident Funds are basically means of social security. Like once a person is basically working, salaried employees working, they are earning the income. They might spend their income, during the period when they are, working. However, once they are retired, so they have no source of income. How to live their retired life decently? For that purpose, government has made certain rules, certain acts, certain provisions, now which are basically known as Provident Fund Acts. So we have different Provident Fund Acts. One is Provident Fund Act 1925. Another is Provident Fund and Miscellaneous Provisions Act 1952. Therein the government has basically tried to make the provisions like every organization which is having 20 or more employees, they should be covered by the Provident Fund. Now what exactly is Provident Fund? It is one type of the retirement benefit. Now wherein employee while he is working, out of his salary he will contribute a certain specified amount which is mentioned under the Provident Fund Act. That is called minimum contribution. That minimum contribution out of his salary he will be putting into the Provident Fund. Moreover, his employer would also be contributing that minimum contribution into the Provident Fund, which is statutorily or legally required. Now that way, this is a form of compulsory saving. So every month they will be taking out certain portion of their salary and they will be depositing into the Provident Fund. Who will be depositing? Answer is employer. Employer will deduct the amount from this employee's salary along with his own contribution. He will deposit it into the Provident Fund. And once the employee gets retired or he leaves the job, he can withdraw this Provident Fund portion. So this will be a lump sum amount and handsome amount which he may invest or he may deposit somewhere, and he can have his better retired life. Now what are the different kind of Provident Funds and what is the taxability under that salary? We will discuss one by one. Now there is first type of Provident Fund which is called Statutory Provident Fund, and such fund is maintained under the provisions of PF Act 1925. Generally, this Provident Fund is maintained by the government or semi-government organization, railways, RBI, universities, recognized educational institutions, etc. Now, they will be maintaining this Provident Fund, and this Provident Fund which is maintained under the provisions of PF Act 1925 is known as Statutory Provident Fund. Firstly, we are discussing the different types of Provident Funds. Then I'll come to their taxability. Now the second type of the Provident Fund is the Provident Fund which is maintained under the provisions of PF Act 1952. Under the PF Act 1952, the employer has an option. He can either open the account of the employee into the Provident Funds which are set up by the government, or he can set up his own private provident fund trust. Now, if he opens up the account of the employee in the government provident fund, they are by default known as recognized provident funds. However, if the employer maintains his own private provident fund trust, it would be called recognized only if it has received the recognition of the income tax department. If they have set up the provident fund but it has not received the recognition of income tax department, then it would be called unrecognized provident fund. So this way, there are two provident funds under the provisions of PF Act 1952. One is recognized provident fund, another is called unrecognized provident fund. Now, the next type of provident fund is, which is called public provident fund. Public provident fund is set up under the provisions of PPF Act or Public Provident Fund Act. In this provident fund, employer does not make any contribution. It is for opening an account in the PPF, it is not necessary that you are a salaried employee or you are in a job. Any person can open up an account in the PPF account, even a housewife, even a businessman. Any person can open up an account under the PPF Act. This account can be opened in the branches of the Post Office, State Bank of India and other certain banks. Now, amount is to be contributed into the multiples of 500 rupees. Earlier, the maximum amount to be contributed in PPF Act in a year was 70,000. Now its limit has been raised to rupees 1,50,000. Now, we have already heard about now these four provident funds. One is statutory provident fund. Another is we have recognized provident fund. Another is unrecognized provident fund. Then we have public provident funds. Now, we would like to see from the point of view of a salaried employee how the taxation would be attracted while investing into these provident funds or withdrawing the money from these provident funds. From taxation point of view, there are three stages. First stage is called contribution stage. That is when we put the money into the provident fund. Who is putting the money into provident fund? Employee is putting the money into provident fund and employer is also making the contribution. Second stage is called accretion stage. Accretion stage means when the amount which has been put into the provident fund is growing. Why? How it is growing? Because just like we put the money into the bank, every year we get the interest. Similarly, interest is credited to the provident fund account on the annual basis. So this amount which has been deposited grows. And the third stage is called withdrawal stage. When we withdraw the money from the provident fund, then this amount is basically, when the employee retires or when employee leaves the job, he withdraws the amount from the provident fund. Now that is the third stage when we have to see the taxation. Now let us talk about the first stage, which is called contribution stage. If an employee gets the salary, there is a tax on such salary. How? Because this is taxable income, this is the part of taxable income and he'll pay tax on that. Now after paying the tax on salary, if a person deposits such amount into bank or into provident fund or somewhere else, this is called application of income and it is no longer taxable. If an employee contributes the amount into the provident fund, it will not become taxable just by putting the money into the provident fund because he has already paid the tax on it. But there is an incentive. Like I told you earlier also, from the gross total income, there are certain deductions which are allowed when we put the money into the certain specified areas. Similarly, if an employee puts the money into the provident fund, he gets the deduction under section 80C. So, if the employee contributes the money into the provident fund, there is no tax on that. But there is a tax incentive that whatever money is put into the provident fund, it will get the deduction under section 80C up to rupees 1 lakh for assessment year 14-15. But for the next assessment year 15-16, this limit has been increased to rupees 1,50,000. Now, as far as employer's contribution is concerned, if the employer contributes the money into the statutory provident fund, it is not taxable for employee, because ultimately beneficiary is employee. Money is being put by the employer into provident fund, but later on, when the employee retires, this money will be received by the employee, not by the employer. So it is a benefit benefit to the employee from the employer. If the employer puts the money into the statutory provident fund, it is not at all taxable. If the employer puts the money into the recognized provident fund, and if it is up to 12% of salary, then it is not taxable. But any contribution of employer beyond the 12% of salary would become taxable in the hands of employee. Now, if the employer puts the money into the unrecognized provident fund, it is not taxable at the contribution stage, but it will become taxable at the withdrawal stage. As far as PPF is concerned, employer does not contribute, it is only the employee who contributes. Now comes the second stage. In the second stage, interest is credited to the provident fund. If the interest is credited to the statutory provident fund, it is not taxable, it is exempt. In the recognized provident fund, if the interest is credited up to 9.5%, then it is exempt from tax. Any interest credited beyond 9.5% would become taxable in the hands of the employee under the head salary. Then, if the interest is credited to the unrecognized provident fund, it is not taxable at the crediting stage or accretion stage, but it will become taxable at the withdrawal stage. If the interest is credited into the public provident fund, it is exempt from tax. Now the last stage is withdrawal stage. When the amount is withdrawn by the employee from the provident fund, if it is statutory provident fund, it is exempt. If it is recognized provident fund, it is exempt if the recognized provident fund was maintained continuously for the 5 years before the withdrawal of the amount. That means if you withdraw the amount before 5 years, then it would become taxable. It would become taxable just like unrecognized provident fund. However, if the recognized provident fund was maintained for 5 years or more, and amount is withdrawn, it is not taxable, it is exempt from tax. As far as unrecognized provident fund is concerned, employee's own contribution, that means whatever money was put by the employee during the tenure of his service would not be taxable. But interest on employee's own contribution is taxable under that income from other sources. Employer's contribution and interest on employer's contribution is taxable under that salary. And lastly, in case of public provident fund, whatever money you withdraw, it is exempt from tax. So I hope you might have understood the treatment of the tax treatment of the provident fund. We can take up the next question.